If you're a student loan borrower, investing is different. You're in a much higher tax bracket than other people. And the main reason why is because you're losing 10% of your income to income driven repayment. So I'm going to show you in this video how to avoid losing so much in investment performance. And I'm going to show you hidden fees that you don't even realize that you're probably paying to the government in the form of higher taxes. And I'm going to show you portfolio construction techniques to try to avoid that. Let's look at a very typical allocation when investing, 50-50 in the total US stock market index fund and the total international stock market index fund. So the dividend yields of these two funds are very different. The US fund yields about 1.3% as the time that I recorded this, and the total international index fund yields about 3.3%. But that's not the only difference in the dividend yields. The composition of those dividends is also very different. So for US funds in particular, US funds have a lot more qualified dividends than international funds do. What does that mean? Qualified dividends get taxed at a preferred rate of 15 or 20% capital gains rates, depending on what your income is. So there are some non-qualified dividends in US total stock market index funds, but not very much. So the vast majority of dividends for US funds get taxed at preferential tax rates. Now for international index funds, it's a little different. So international index funds, you'll notice the dividend yield is higher, but also that there's a lot more dividends in that are what's considered non-qualified. What non-qualified really means is a percentage of that yield gets taxed at ordinary rates. So if you have 3.3%, about 68% of that yield in an international fund would be taxed at capital gains rates, and 32% of that would be taxed at the higher ordinary income tax rates that you might have interest income be taxed at. So the takeaway is US funds are a lot more tax efficient for brokerage accounts than international funds are. So if you just put 50-50 in each, in your brokerage and retirement account, which is certainly a reasonable allocation, it's a simple allocation, the loss to taxes for somebody in a very moderate income tax bracket, so just hypothetically, let's say a pharmacist making $100,000 a year, going for the SAVE plan, living in Georgia. So their marginal federal rate might be about 22%, state about 5%, and IDR 10%. And they're in the 15% capital gains tax bracket. So if you take all of those taxes into consideration, the loss to taxes is about 0.73 on this dividend yield. Now, if this person didn't have an IDR payment, you see that they only lose 0.5%. So that's a pretty large loss, just from being on an IDR plan. So this person's, total portfolio, again, they're losing, almost 0.25% just because they're on the SAVE plan. Now, how do you combat that? One strategy is to do asset location. And so what I mean by that is, so first of all, just to talk a little bit more about this dividend yield, take a look at the loss to taxes, 0.73%. So the pre-tax dividend yield of a 50-50 allocation here is 2.3. So the net dividend yield after taxes for the whole thing is about 1.57%. Now, what you could do instead, again, is asset location, which what that would mean would be taking the US total stock market index fund and splitting it into its large cap growth and large cap value components, and then overweighting the part that's growth in the brokerage account and underweighting the part that's value, and then doing the inverse of that in the retirement account. Now, what does this actually do? So if you take the half of the stock market, the US stock market that's growth, that dividend yield is only about 0.5% as of June 2024 when I recorded this. Now, this is going to stay accurate long term because generally speaking, international almost always yields more than US stocks because of just the structure of these funds. And then growth, tends to always yield more than value. So this overall theme still holds regardless of what the market is doing, really. Now, if you split up the growth and the value components, you're still capturing the broad market. But what you're doing is you're capturing more of the growth stocks that yield low amounts in your brokerage account, and you're putting less in the value stocks that yield higher in the brokerage account. And the same thing is true for underweighting international in this. So by putting less at international in the brokerage account, you're also incurring lower dividend yield, and having lower taxes on that. So you'll notice the loss to taxes with this different allocation in the brokerage account is 0.64. Now you might say that's about 0.1% almost. Is that really worth it? Because look, your net dividend yield is lower. Well, again, what happens is if you have the retirement account be the inverse of this, so the retirement account, you're underweighting to growth, overweighting to value, overweighting to international. The overall allocation of the portfolio, for a lot of people, since they have a similar amount in brokerage and retirement, the overall allocation of the portfolio could be the same or very similar. And so since you have a higher yield in your retirement account and a lower yield in your brokerage account, the overall allocation is quite similar, except that you're saving about 0.1% in performance and taxes on your brokerage account. Now, does this matter? Well, it's not just investing in stocks that matters. It's also your bonds. And so a whole lot of student loan borrowers are completely under optimized on their interest income. So here's an example. So pretend you've got a California physician going for PSLF, and let's say she's earning 5% in a high yield savings account. Well, in terms of federal rates, she's in 35% rate. ACA tax, because she's above the 200K limit, that's about almost 4%. State's about 10, and IDR is about 10. So in total, she's losing about 60% of her interest income to taxes. So instead of earning 5%, her net yield is about 2%, 2.05 to be more precise. So think about how many people put investments in their portfolio without thinking about what is the after-tax yield. And the reality is a student loan borrower gets hit much harder than other people do. So take a look at that. Net yield, if you're not a student loan borrower with an IDR plan, 2.5, but 2.05 if you are a student loan borrower. So what happens is the tax efficiency of portfolios is significantly damaged when you are a student loan borrower. And so the importance of asset location is just exponentially more important. That means putting lower yielding, more tax efficient investments in your brokerage account and putting less tax efficient investments that have higher yields, that have more of a tax bite in your retirement accounts, and overall trying to keep the allocation to the desired amount. Now, IDR sensitive investing, it's not just about asset location. There's actually a whole lot of things. I just wanted to talk about asset location today in particular because I think it demonstrates the complexity and the reasons to pay attention as a student loan borrower when investing. So other things that matter: average cost versus specific identification of shares. So when you go to sell something in your Vanguard account, most people are just going to select the default method when you go and sell stocks, which is average cost. Now, what that means is you're going to take, your total market value and divide by the total cost basis. You're going to look and see, how much of a gain is on the entire position. And then when you go sell a portion of that position, you're going to incur a pro rata amount of gains, which is really not helpful. So an easy way to think about this is, say you have, invested $10,000 at two different times. Let's say the earlier investment is worth $20,000, the other investment's worth the same of what you put in. So that means the total value of the account is $30,000, but you've invested $20,000. But that $20K is made up of two separate $10,000 investments, one of which is worth $20,000. Let's say you invested 10 years ago, and the other one's $10,000 today. So if you go and then sell $10,000, what you could do is do a specific identification of shares and have that $10,000 be sold with no gain. But what most people often do is they go to the average cost method, and if you do that, then you're talking about incurring, a $3,000 gain, probably losing about 10% of your performance just in taxes. And it's made worse by the fact that people are student loan borrowers. Now, another thing to think about, tax loss harvesting. Tax loss harvesting is when you generate paper losses over time that you use to put on your tax return to carry forward so that when you have a big gain, for example, from, say, selling a dental or a veterinary practice, or from incurring a tax bomb when you sell a bunch of assets to pay the tax bomb with on your student loans, that's something that can be very helpful at offsetting 5 or even 6 figures of taxes due in the future. A lot of people don't maximize pre-tax retirement account contributions. So if you're thinking about, how do I maximize my pre-tax buckets? Sometimes people have simple IRAs when they need 401ks. Sometimes people need to set up solo 401ks, but they are instead doing traditional IRAs. There's all kinds of ways that student loan borrowers are not maximizing their pre-tax accounts and avoiding this huge tax hit that they get hit with from IDR and other taxes. Also, a lot of folks make mistakes based off of past performance and behavioral mistakes. So a lot of times people will look at what's performed well recently. For example, if certain types of crypto have done really well, then people will go and rush and put a lot of money into that. Or if U.S. growth stocks have done really well, people will rush and put a lot of money into that instead of having more of a long-term approach instead. Now, behavioral mistakes are also things like selling in a market downturn. So many people panic and sell when the market goes south, and we haven't had to experience a really negative market since the financial crisis as of recording this, except for a very brief period during the pandemic. Now, another issue that plagues student loan borrowers is student loan borrowers are really smart. You're really smart. You have a lot of education. You are, at a minimum in the top quartile and probably higher than that in terms of your academic success. And so that makes you even more prone to overconfidence bias than the average investor. Every investor thinks they're better than average, or at least most of them do. And if you can realize that, it's going to save you a lot of pain and grief. So people tend to attribute unusual success to their skill, and then they tend to attribute, lack of success with bad luck. And so it's important to realize that very many investors underperform the market simply because they're not willing to admit their own mortality and their own humility. So that's a real helpful lesson. And then segment your entertainment investing from serious investing. Serious investing is sober-minded, it is careful, it is paying attention to things like taxes, and it's long-term. And a lot of times people will get caught up in, what's happening on Reddit or meme stocks or what's the hottest thing on YouTube or something, and then that is not a successful way to invest for the long term. That is entertainment investing, which is fine, but it's important to keep it to a portion of your portfolio. So this is an introduction to IDR sensitive investing for student loan borrowers. And the big thing to think about, the big takeaway, is taxes take a big chunk out of your portfolio every year. It's the hidden AUM fee that people don't even know they're paying. And a lot of times this is a fairly tax efficient portfolio that I'm showing and then optimizing. Oftentimes people come to us with, just really inefficient portfolios, stuff with lots of active funds, stuff that's throwing off huge capital gains distributions, stuff that's very tax inefficient, stuff that has high dividend yields. So a lot of times the tax bite that people are losing out of their portfolios is much, much worse than what I'm showing here. So if you pay attention to taxes, you're way ahead of the game. I hope you follow Student Loan Planner and comment if you have any questions in this video. And, if you have any questions or feedback about this, we'd love to hear it. Just put them in the comments. Thanks for watching.